Two great REITs at big discount, magnificent gain potential because who doesn't love buying the dip, especially when it pays dividends? In a market that seems to flip between existential dread and blind optimism faster than your ex's dating life, it's easy to overlook the real estate investment trusts, REITs, hiding in plain sight. Especially now, when inflation anxiety, rate hikes, and economic doomscrolling have hammered REITs so hard you'd think they were the main character in a tragic Netflix docuseries. But guess what? That's great news for the rest of us. Because while the Wall Street herd flees anything interest rate sensitive like it's radioactive, savvy investors know one thing. This is when you feast. You don't buy REITs at the top when CNBC finally learns how to pronounce dividend yield. You buy when they're cheap, beaten up, and begging for attention, like your favorite comfort stock during a bear market binge. So let's talk about two REITs trading at significant discounts right now, with the kind of upside potential that'll make you look like a genius by 2026. Or at the very least, a genius with income. 1. Alexandria Real Estate Equities, R. The nerdy lab landlord you shouldn't ignore. Let's face it, nobody dreams of owning office REITs right now. Between remote work, downsizing, and the fact that Zoom meetings still exist, the office space sector has been left for dead. And yet, Alexandria Real Estate Equities, R, isn't your average cubicle farm. These guys don't rent out soul-crushing fluorescent lighted spaces to insurance companies. They own life science campuses in America's most prestigious R&D hubs, Boston, San Diego, San Francisco, and the Research Triangle. Think wet labs, biotech headquarters, and next-gen pharma campuses. You know, places where nerds are busy trying to cure cancer and engineer the next CRISPR breakthrough. ARE's tenants include Moderna, Bristol-Myers Squibb, and Eli Lilly. That's right, the same companies that actually made money during COVID. And what happened to ARE's share price? It got dragged down like it was leasing WeWork suites to Bitcoin bros. Here's the kicker. ARE is trading at a massive discount to NAV, net asset value, somewhere between 20 to 30% depending on who you ask. The dividend yield? Over 4%. That's higher than a 10-year treasury, and unlike treasuries, ARE owns physical assets that don't evaporate when the Fed sneezes. The management team is seasoned, the balance sheet is strong, and while the stock took a punch, its long-term leases and irreplaceable locations make it more resilient than it gets credit for. Buy the fear, collect the rent. 2. Vici Properties, Vici. Sin pays, baby, and this REIT owns the strip. If Alexandria is the straight-laced valedictorian of the REIT world, Vici Properties, Vici, is the charming class clown who always somehow lands on top. And by on top, I mean they literally own the Las Vegas Strip. Yes, Vici owns Caesars Palace, MGM Grand, Mandalay Bay, and more than 50 other experiential properties. So while the rest of the economy panics over rising rates and geopolitical chaos, Vici investors are collecting rent from blackjack tables, roller coasters, and overpriced buffet lines. Even better, Vici operates as a triple net lease REIT. That means tenants, not Vici, are responsible for maintenance, insurance, and taxes. Vici just sits back and counts the cash while someone else replaces the carpet after yet another bachelorette weekend gone wild. And let's be honest, people aren't giving up Vegas. Not in this lifetime. Post-pandemic, travel and entertainment are bouncing back harder than your drunk uncle at a roulette table. VICI's rent collection rate was 100% even during the darkest days of COVID. That's not just resilience, that's gangster-level rent collecting. The stock is currently trading at a discount to its NAV and is yielding around 5.7%, with steady dividend growth to boot. Vici has also diversified, expanding into regional casinos and entertainment districts across the US, making it less dependent on Vegas. Though, let's be real, Vegas is doing just fine. Why the discounts? It's the same tired story. The Fed won't shut up about higher for longer, and REITs get punished because they're sensitive to rising rates. Higher borrowing costs equals lower margins. Lower future cash flow equals lower present value. Blah blah blah. It's all very MBA textbook. But here's what those spreadsheets don't tell you. Once rate expectations stabilize, and they will, these discounts won't last. The market tends to price in fear aggressively and irrationally. That creates windows for REIT investors who are paying attention. Not to mention, both ARR and VICI have built-in inflation protection via long-term leases with escalators. And let's not forget, REITs are required by law to distribute at least 90% of their taxable income as dividends. That's not a promise, that's an obligation. You're not hoping for yield. You're entitled to it. The buy and hold payoff. If you believe in the slow death of science, medicine, and gambling, then by all means, pass on ARR and VICI. But if you suspect that Americans will continue to discover new drugs, bet on sports they barely understand, and do it all from physical locations that REITs own, then buying these two discounted juggernauts might just be the smartest long-term move you make this year. ARR gives you stability, elite tenants, and exposure to innovation. VICI offers high yield, defensive cash flow, and a stake in America's favorite guilty pleasures. Both are trading below intrinsic value and have the kind of embedded growth potential that turns forgotten REITs into portfolio cornerstones. In other words, this ain't just bottom fishing. This is buying the whole boat while it's on clearance. Final word, bet on bricks and mortar with brains and buzz in a world where tech stocks get the spotlight and meme stocks get the memes. Good old-fashioned real estate, with long-term leases, pricing power, and tangible value, is easy to overlook. But these two REITs remind us that boring can be beautiful, especially when it pays you every quarter to stick around. So go ahead, ignore the noise, tune out the bond market hysteria, and scoop up some discounted real estate without having to fix a toilet or deal with a tenant who thinks rent is optional. Because when the cycle turns, and it always does, you'll be the one holding the winners. And isn't that what magnificent gain potential is all about?